With down payments being the biggest hurdle for most home buyers, many often turn to their 401k and IRA to help with the down payment. In this video, I'm going to teach you everything you need to know before touching that retirement savings. There are two things you need to think about before touching that retirement savings to purchase your next house. The first is whether you should even do it, and the second is, if you are, what kind of distribution should you take? Generally speaking, I'm against people taking raw distributions. Distribution is where you pull the money out and you never intend on paying it back. The reason is, IRAs and 401ks, you can only put a certain amount of money away every year for your retirement. And the power is how that money grows over 20, 30, 40 years. So once you pull it out, there's some significant long-term appreciation that you could lose. When you take a loan from your 401k, there are several things to consider. For one, where are you in the market cycle? Are stocks rich or have they just crashed? Number two is the duration of time you agree to pay that loan back. So I'll give you some examples. In 2007, the stock market was about a peak, right? It was about S&P 1500. And then all of a sudden in 2008, it bottomed in March at 666. So the stock market just got pummeled. So whoever took a loan in 2007 and then slowly paid it back for a few years looked like a genius. Now, on the flip side, people that bought houses in 2009 and they took 401k loans, they missed tremendous upside if they didn't pay that loan back quickly. I like to see home buyers pay that 401k loan off as fast as they possibly can. The reason being is markets are so unpredictable. You blink your eye and the stock market runs 10 or 20%. And all that lost opportunity, that money making money for you, is lost. Your 65-year-old self would look at you and say, why didn't you put that money back in the market? So when I have home buyers that are entertaining a 401k loan, we first often look at the alternatives. If putting less money down is possible, what does that look like? And then compare that to borrowing the 401k loan and having a payment come out of your paycheck. In many cases, the lower down payment loan actually puts more money in your bank account every month. Most financial advisors would tell you not to take a loan from your 401k. And for the most part, I agree with them because I try to show those lower down payment options so people can keep their money making money for them and build a solid net worth for retirement. Now, in those cases where people don't have another option, I do believe that money is there for investment. If you take out a small amount of money from your 401k and you use that to buy a house, and that house appreciates 10%, well, then you made money on that investment. It was well worth it. Your 65-year-old self would still be very proud of you. But there is one big risk to consider. 401k loans are generally meant for your current employer. And oftentimes, if you have a job change, they give you 60 days to fully pay back that 401k loan, or they consider it a distribution. You get a 10% penalty and then pay taxes. Put that in perspective, if you had a $30,000 401k loan, that could be $3,000 in penalty plus another $9,000 in taxes. So it's a pretty steep risk. At the Downs Group of Ellen Mortgage, we take time to show you all the different down payment options so you can measure the risk and reward of taking that 401k loan or the IRA distribution. In the end, our goal is to just make sure you have extreme confidence in the financing package that you choose to buy your new home.